Hey, so I want to go over XLF. This is the financial sector of the stock market. Um, I did find some news articles that I thought could be beneficial as we're checking in on this one again. Um, I guess before we go into the news, um, I just wanted to give a brief update of where it was last time we looked. Then we'll go into the news, then technical analysis, and then we'll close this one up. So for XLF, last time we looked at this was on June 1st, so about a month ago. It was trading at $32 at that time. We had buy points marked at 25 and 30 seemed to be the better figure, with resistance at 36. So pretty narrow window. We also noted that the average yearly return is going to average about 4%. Uh, Also, we must have seen in the previous video that we were expecting 10% growth in 2023. So we'll see that in correlation to the technicals. And then they were projecting year 2024 would be a down year for this sector. So we'll, of course, see how that plays out. But so let's go into some news. What's been going on with this ETF? So right off the bat, there was this debt ceiling, and so this article just goes into there's drama in the equity markets. Generally, ended up in the hits generally ended up in the 5 to 6 area. This is in years which the debt ceiling drama has occurred in the context of other major problems. Hits have ranged to 10 to 20%. So let's go to the technicals just for a minute. I'm going to point out that this was on May 16th. So this was right around when the debt ceiling was happening. And our range is really 5% all the way up to 20. So again, May 16th. So let's zoom in here. May 16th, right about in this week. Ever since that came up, this ETF has been improving. There's been pullbacks, but overall, it's going up again. Maybe, I guess, I'm not sure when the deal actually was signed. Clearly, it was after this. Uh, hmm. Yeah, so unless we're counting this as the 5% or maybe this the 10%, he kind of got this one wrong. But since 2011, the average decline in financials during the debt ceiling fights has been about 8.7%. So I'd be curious. I'd have to look back to see when was the debt ceiling actually approved or when was it all going down. Because, if we look at the technicals, there's clearly a dip here. So if this was right around, it couldn't be there. Maybe this was the dip. I say this one isn't because it was March. I feel like that was still too soon. But maybe that is what occurred there. And if that is, it went from 35 down to about 30. So 5, what's 5? 5 divided by 35. That's about 14% hit. So I'm trying to fight the case for that guy. So let's go back here. Um, Also in this sector, there was the 3 regional lenders. Whoops. Let me go back here. There was 3 regional lenders that failed since early March, and then of course the debt ceiling added another pressure point to this ETF. Later on, apparently a lot of people were shorting the regional banking ETF, which makes sense. It rose to 92% from 74%, so that's putting pressure on not necessarily the biggest contributors to this ETF, but still, this ETF is made up of dozens of companies, and regional banks make up a decent percentage. The short interest as a percentage of tradable float for the $28.6 billion sector XLF increased by over 50% since March. So let's go back to that ETF or our technical analysis. Just a second here. So since March, this is when everyone was shorting it. Since then, it fell real fast. So if you started back up here at 35, yeah, you made whatever we showed, about 16%. But yeah, if you missed it, it's been going up ever since, pretty steadily too. It feels like the ETFs are being used not only for outright bets, but a hedging for managers that own underlying bank shares. So that kind of makes sense. They're trying to balance out any potential damage, and that might be leading to why there was such an interest in shorting. Here we have the financial services stocks appear to be well positioned to benefit from a potential debt ceiling deal. The increased borrowing that may result from a rising debt limit could lead to higher profits for banks and other financial institutions. The large established national banks are the ones that are expected to gain the most from increased government borrowing. Good news there. Banks and insurance companies benefits, which make up this ETF, benefits from higher interest rates. So that's kind of been the debate that are they going to continue to add to the federal interest rate? If that does, this ETF should benefit. As rates rise, financial institutions can charge higher interest on loans and other financial products. This will lead to increased profitability and improved net interest margins. Following the last federal meeting, officials indicated there could be 2 more quarter percentage point increases this year. The Fed's benchmark borrowing rate is currently pegged in a range of 5 to 5.25. So I'd need to, unless someone has the answer and can share it down below, that is something we'll need to look at. Where is the current interest rate? How close is it? Has it peaked? Is it going to continue rising? Hopefully we uncover that information and we can share it later. And again, this article, this is the last of the news section. This was on June 23rd. That was the last thing I saw for this. So let's shift into the technicals here. So again, last time we looked at this was on June 1st. And it was trading at 32, buy at 30, resistance at 36. So let's get that off the screen and get the what is it here? Here we go. So the technicals. Let's see. So we looked back here. June 1st, so right around 32, that's what we marked. We had buy point at 30, also 25. Okay, so 25 is the green line, and 30 was the yellow and purple line, the merger here. Bottom of the yellow line, top of the purple. It has not come back that low. Last time it came that close was end of March. Currently it's on the rise. This one's looking like it's going to be fair value. But let's kind of expand upon what we have here. Number one, we're updating it to 34. Or no, 33. Yeah, so last time we looked at it, it's pretty much just gone straight up. There's a couple pullbacks, but overall, it's just increased. But not by much, going from 32 to 33. Buy points right now. I would buy this one at the earliest 31. So I'm going to update the 30 to 31. 25. 25 is in there because that is down here. That is the bottom of the purple range. The purple is, I believe, the longer range. Um, both these ranges pretty much started at the same time. No, not necessarily. So the purple range, we'll update this too. Average yearly return, 4.3%. Okay. Um, Long-term uptrend since about November 2008. Short-term uptrend, which would be the yellow. The yellow, I mean, you could make a case. I mean, the yellow's not all that great, to be honest. Man, that one's tricky. When could you say that started? I would say definitely here. We'll go here. So from about November of 2016. Since November 2016. The significance of those lines since about whatever 2016. It rarely's gone below there. There's really just one instance which lasted a month, about 2 months, a month and a half here. And then during the crash of 2020, it took about, let's see, the beginning of March, it took about a year to get back. Not a year, about 8 months. So 2/3 of a year to get back. Once it was in that range, it overextended. A lot of companies did that. A lot of ETFs did that. And now it's kind of back in that range. So I kind of want to roll with the yellow. So what I'm saying for this one, buy point of 31. That is the bold figure. I like it. 25 would just be even better. You'd still be in that uptrend. So I like that one. But 31 would be the point to buy. And then we still have resistance about 36, so not much has changed. I can update the date. In terms of where this one, so these boxes, that those are like just guesses of where I think this one might end up. Based on the news, kind of feel like it's going to be fair value in this range. I think it'll just keep climbing up. So it did shift up some. Based on this, that makes it a little more favorable. But overall, I'd wait on this one. And again, even if we got it at the bottom and cashed out at the top, I can't imagine this one being all that great of a return, especially if we push this one out like 2-3 years. It's going to end up around 4%. I wanted to look at this expecting 10% figure for 2023, just to give an example of this potentially. So I'm just going to assume that they said 10% growth at the very beginning of the year. And the very beginning was about $34. $34, 10% of that. That's about $38. So 38. Does that track for me? I could see 37. 37's within that range. 38's like right there. But overall, 10%. We're currently at 33. So that 10% is still on the table. Um, it's just, again, we're going for like 20, 25%, but 10% is pretty good. I think that's why I'm still going to give it that fair marking, which is blue. Uh, and that pretty much wraps this up. So let's just share our tracker here. So XLF, currently it's at $33. I'm saying I would buy this one at 31, and just due to the average yearly return, which we have in this no column, at about 4%. That's why even if it did touch that buy point, I'd probably continue to fish for other stocks. But if we just want low um, guaranteed returns, yeah, 31. Chances are I would add maybe one share. Just slowly build up those slow but guaranteed earners. Um, Expecting 10% this year. I do find that reasonable, even at today's price around 33. Then they want down. They're saying it's going to pull back in 2024. Again, I think just the longer you go out, you're still going to get that 4%. So I wouldn't be too concerned. If you can catch it below, like down in by the lower end of that purple uptrend, that would be like the ideal. It's just those types of situations don't seem to come by as frequently with this one. Uh, just keeping that in mind. ETF concentration, nothing really changed much here. So last time we looked at this was end of April. I'm surprised I didn't update that in June. But since then, end of April till now, beginning of July, all that's really changed is Berkshire went up about 0.6%, and it looks like JP Morgan also went up about 0.6%. Everything else, it was less than that. And these two yellow highlighted increases, that's barely even worth mentioning. It's nothing. It was 0.6%, so not even a full percent. But those were the changes. Otherwise, we are, I believe, Berkshire's in our portfolio, Visa's in our portfolio. Possibly we're going to add MasterCard, but we'll see. And this is just to see if we can find individual stocks to capitalize on something like this. Because, again, overall, the ETF as a whole, with like these 100 companies, increases about 4%. But if we can catch one or two of the top earners, maybe those will grow 10%, 15%. I'd be more inclined to pick those and kind of play them out over short and long term. But that pretty much wraps this up. If you have any questions, want to add anything that I might have missed, I'd be happy to read that. Otherwise, please like, subscribe, and I'll see you on the next one.